Hey guys, welcome back to the channel. So I recently read Warren Buffett's letters for the second time, and I wrote down my 5 biggest takeaways to share with you guys today. There's so much wisdom in these letters that it was hard to narrow it down to just 5 points. So I'll probably have to make a part 2 of this video at some point in the future. So let's get started. The first key lesson from Buffett that I want to talk about is the importance of management. In virtually all of his letters from 1977 to 2021, Buffett talks about how important a quality management team is for a business, and how grateful he is to have the managers currently running the dozens of businesses that Berkshire owns. It's so important to him that it's part of his criteria for buying stocks, and even more so for buying entire businesses. With Buffett's approach to buying businesses, he likes to let the current management run the business as they always have without interference, and he prefers to not get involved with day-to-day operations of the business. Throughout his letters, Buffett constantly praises his excellent managers, and he talks about their achievements and individual character in the highest possible way, and none more so than the famous Mrs. Blumpkin, aka Mrs. B. In Buffett's 1983 letter, we were introduced to the legendary Mrs. B, who with no formal education, barely any English, and only $500 to her name, created the largest and most successful furniture store in the US, Nebraska Furniture Mart. Buffett had admired the business for decades, and when Mrs. B was willing to sell the business for family reasons, Buffett was eager to buy and a deal was quickly reached. But with one condition: Mrs. B and her family would retain 10% ownership and keep running the business as they had the last 30 years. Now, he doesn't do this because he is lazy or incapable, but because he has the humility and wisdom to understand that the current management would run the business far better than he could. Mrs. B is just one of many managers that Buffett speaks incredibly highly of, and it really shows how highly he weighs the management team when he's buying both businesses and stocks. As well as having great character and work ethic, Buffett also makes sure their operational performance passes the test of achieving a high return on capital employed, and not just a consistent rise in earnings per share. Buffett says this is because in high return businesses, like insurance, mistakes can be made and great results can still be achieved, as opposed to a low return business, where even very good management can only average good results. So the quality of the business comes first, and then the management. Buffett says that when you buy a great business, having a quality manager really makes the difference between having good results and achieving world-class results over a long period, as shown by See's Candy, Geico, and Nebraska Furniture Mart. So overall, while Buffett prefers to own high-quality businesses over low-return ones, he says one of the biggest drivers of Berkshire's success was the quality of the managers running these great businesses. And one of my biggest takeaways is we can use this principle ourselves when looking at our own companies or potential investments. There's a common misconception in investing that if a business experiences growth, especially high growth, that it's always good. But according to Buffett, looking at the growth of a business without looking at this other key figure is absolutely meaningless. Buffett says most companies define record earnings as a new high in earnings per share. Since businesses add from year to year to their equity base, we find nothing particularly noteworthy about a business growing their capital by 10% and their EPS by 5%, because in reality, the return on capital is actually lower than it was previously. So essentially, growth is only beneficial if the new capital, or incremental capital, also generates high returns. Otherwise, the management are destroying shareholder value in the long term. He says, for an increase in profits to be evaluated properly, it must be compared with the incremental capital required to produce it. Buffett gives an example of a gruesome type of business in airlines. A business that grows revenue rapidly, requires significant incremental capital to propel the growth, and then earns little to no money. This principle is why I start every stock analysis by looking at the return on incremental capital to see if a business is creating or destroying value with their growth. Overall, this principle from Buffett has probably had the biggest effect on my investing philosophy. I used to think that growth was inherently good, and that the higher the growth rate, the better, without even considering how much incremental capital was required to produce that growth. And that last part is critical to understanding if a business is high quality or just average. The next takeaway from Buffett's letters is that forming macro opinions or listening to macro or market predictions is a waste of time, because it may blur your vision of the facts that are truly important. This is something I've really tried to implement over the last few years because of all the macro noise that's currently going on all around us. It doesn't matter what news site you look at. There's always one article about the impending doom for the market, or something about inflation or interest rate predictions. And Buffett says we should ignore all of this when it comes to making investment decisions. When Buffett made 2 purchases in 1986 and 1993, what the economy, the interest rates, or the stock market might do in the years following was of no importance to him in making those investments. And with Charlie and himself, in the 54 years they've worked together, they have never foregone an attractive purchase because of the macro or political environment. This is something that sounds easy in theory, but it's much harder in practice because of how the human brain works. When the majority of people are saying something about the market or about inflation, then sometimes it can be hard to ignore because of social proof. As a species, when we're unsure about something, we tend to look around us to see what the majority are doing and saying to get answers. And most rational people know that they have no idea what the macro environment will do or how the general market will perform. So when a bunch of people are saying the same thing with certainty over and over again, it can actually subconsciously affect your decision making if you're not actively tuning it out. In reality, nobody really knows what the future will hold. And unless you're a short-term investor or a Graham-style investor, the macro environment shouldn't really affect your investing results if you're a long-term investor. Great businesses can still perform, and some even thrive in high inflationary environments. Buffett talks about this when he acknowledged how some of his acquisitions have been dazzling, and that two major categories stand out. And the first involves businesses that are particularly well adapted to an inflationary environment. Such a business must have two characteristics. One, an ability to raise prices rather easily, without fear of loss of volume. And two, an ability to accommodate large dollar increases in business, with only minor additional investment of capital. Funny enough, the other major category is the first takeaway, which was management being superstars. So the biggest lesson I learned from Buffett regarding macro is just to ignore it because it's a waste of time, and you could better spend that energy researching great businesses. The fourth key takeaway from Buffett's letters is around share repurchases, and how like growth is not always a good decision that creates value for shareholders. It is true that some businesses who buy back their own shares have created huge value for shareholders, and Buffett gives the example of Geico, who over a span of 2 years, through amazing capital allocation, reduced its shares outstanding from 34 million to 21 million. Now and again, share repurchases can be the best use of excess capital within a great business, but only if a business is selling for far below its intrinsic value. So essentially, if a business is buying back its own shares when they're trading far above their intrinsic value, then they're actually reducing per share intrinsic value. Basically, it's like the management trading in $10 bills for $5 bills and thinking it's a good capital allocation decision, when in reality, it would have been better to just retain the earnings or pay them out as a dividend. So not all share buybacks are created equal, and they can reduce shareholder value just as much as increase it if used incorrectly. My fifth and final takeaway from Buffett's letters is that it's okay to make plenty of mistakes, as long as you learn from it and grow as a result. In his letters, Buffett points out so many mistakes he's made over his career, and how they still achieved their record despite making lots of errors. And he doesn't take himself too seriously with it either. There's one he mentions in 2007, where he made a big mistake when he said yes to buying Dexter shoes, and how he compounded this error massively by agreeing to use Berkshire shares to pay for the acquisition, essentially giving away 1% of a great compounder for a worthless company. He said this is the worst deal he's ever made, but he'll make more mistakes in the future and you can bet on it. Instead of getting defensive or trying to hide his mistakes, Buffett makes jokes about it and plays it off. But from everything we've been told about Buffett from people close to him, we know he's a voracious learning machine who learns lessons from every mistake he's ever made. Something that's interesting is that Buffett says some of his worst mistakes were stock and business purchases whose virtues he understood yet didn't make. Quality businesses inside his circle of competence that were served up on a platter. And he jokes about how this thumb sucking has cost Berkshire shareholders massively. It's good to know that Buffett makes both mistakes of omission and commission, and it shows that he is in fact human after all. If Warren Buffett can stare right in the face of a great investment opportunity and not pull the trigger, then it's definitely going to happen to us. And it's already happened to me a few times with a few different companies. One of my biggest mistakes of omission was not buying Nvidia in 2020, when it was inside my circle of competence and it was something I really understood. It's annoying, but it happens, and all you can do is try to learn from it. Overall, the key lesson here is don't be afraid to make mistakes, and don't shy away from them when you do. Charlie Munger is a huge advocate of analysing your mistakes just as much as your successes if you want to grow, and Nick Sleep talks about it as well. Nick learned an important lesson when he sold Stagecoach too early because it was a long-term compounder, and it led to Nick holding on to Amazon through all the ups and downs, and it ended up becoming his largest position and one of his biggest wins. So that's my 5 biggest takeaways from Buffett, and I hope you found it interesting. And if you haven't read his letters yet, I highly recommend checking them out. If you enjoyed the video, please hit the like button as it really helps the channel grow. And if you want to see more videos like this one, make sure you hit that subscribe button. If you've watched the video all the way to the end, thank you so much for watching. And if you're still bored, I'll put another video up in the corner that I think you'll find interesting. And as always, this video is not financial advice and I'm not a financial advisor. So please always do your own research before making any investment decisions. So that's it for this video. Thank you so much for watching, and I'll see you guys in the next one.